This is why I have more than $10,000 invested in Amazon today. So, for reference, this is my portfolio. So I own a substantial amount of Amazon. I have around 7% of my entire portfolio in Amazon right now. And year to date, Amazon is up around 5%. It is currently trading at a 37 times earnings, which is historically low for Amazon. And for Amazon, when you're buying the stock, you're not just buying the retail store, you're buying a suite of all these different companies here. Basically, you have Twitch, you have MGM, you have all these different companies here under one umbrella, which is Amazon. It's basically a conglomerate at this point. And for Amazon, this is their culture as well as their network. So the amazing thing about Amazon is that they have a culture that is basically unbreakable, and they have a network effect that is also beneficial for the company in the long run. So the growth loop is as such. You have more companies leading to more retailers, and more retailers driving down prices, and more retailers leading to more products as well, leading to more profit for Amazon. And besides that, they also have an amazing network effect. So Amazon's priority has always been to lower prices for customers. And when that happens, your customer experience will be amazing, which drives traffic. And then that leads to even more sellers. So it's like a feedback loop that will keep helping Amazon improve profits, improve revenues over time. So for Amazon, it is a flywheel of many different things. So the primary focus is on achieving high customer satisfaction, serving as the central axis around which the flywheel operates. It has a superior customer experience, in turn ideally attracting more customers. A large customer base enhances the platform's appeal to third-party sellers and advertisers. More sellers contribute to a broader and improved product offering. A better product offering increases customer satisfaction and drives more purchasers on Amazon platforms. This leads to even more growth for the company. So as you can see, it is sort of like a wheel. It just keeps going on and on and on until Amazon eventually collapses, if it ever happens. So besides that, one of Amazon's most important moat is the infrastructure of the company. So the company has 1.56 million warehouse workers and around 175 fulfillment centers worldwide. So this company has spent billions and billions of dollars on fulfillment centers, and it is impossible for anyone to do so. And all these fulfillment centers will serve as a way to increase your customer satisfaction, which in turn leads to even more profits for Amazon. So for Amazon, this is something that not every single company can replicate, and this is actually why Amazon is one of the strongest e-commerce company in the entire world. So for Amazon, my thesis for the company is one of margin expansion. So as you can see, here are some of the growth numbers for Amazon. Your online sales went up by 6% in 2024. Your third-party sellers went up by around 11%. Your advertising went up by 20%. So advertising is one of the highest margin growers for Amazon. You have your subscription services going up 10%. And AWS as well, which is a high margin revenue source, is up 18% year on year. So as Amazon transitions from growth to profitability, you will see a lot of margin expansion over time, which will drive up the EPS of the company. So let's talk about the different business model for Amazon. So the first one that I'll be talking about is Amazon Prime, their subscription business. So the subscription business is actually one that drives in customer loyalty. So the Amazon Prime, for example, is priced at $15, which is quite low, comparable to Netflix, comparable to other subscription platforms. And on this Amazon Prime subscription, what you're getting is Amazon Prime, of course. You're getting free shipping, you're getting Twitch, you're getting Prime Music, Prime Day benefits, and the price is so cheap that everyone uses it. And that serves as a way for Amazon to have customers sticking around over the long term. Besides that, Amazon also has third-party sellers. So this is like a toll gate business that sellers sign up for. So sellers have to pay an annual fee, sellers have to pay a referral fee, which is the commission. Sellers have to pay the fulfillment fee if they use Amazon FBA. And for this portion, it is a highly predictable recurring revenue business for Amazon as well. So the advertising portion is also another juggernaut in the entire suite of revenues because advertising is extremely high margin as a whole. So for example, Meta has around 80% gross margins in advertising. So you could see similar numbers as well for Amazon if they start increasing the margins for this portion of the business. Last portion, the most important one, is their AWS portion. So for AWS, they are the biggest cloud provider in the entire world. So they have around 30% of the market share right now. And currently it's sort of like an oligopoly between Amazon, Azure, as well as Google Cloud. So for AWS, it is extremely important for any single business relying on it. So for example, this is a Netflix 10K, and this is what they said regarding AWS. So they said, we rely upon Amazon Web Services to operate certain aspects of our service, and any disruption of or interference with our use of the Amazon Web Services operation would impact our operations and our business will be adversely impacted. So this clearly shows how important AWS is for its customers, and even for Netflix, which is a competitor to your Amazon Prime platform, it is so important for them to make sure that AWS is running. And that is the moat for AWS as well, because your customers rely on it so much to the point where they can't cancel their payments for all these different services. So for AWS, this portion has seen incredible operating margin growth. So the margins have gone from around 15% in 2014 to currently upwards of 35%. And a wildcard for Amazon as well is simply just the optionality with your robots. So Amazon has been deploying a lot of different robots in all their fulfillment centers. So for example, this is what Amazon has previously said. They said they launched a new AI foundation model to power its robotic fleet and deploy its 1 millionth robot. So you're seeing a lot of different robots in your fulfillment centers, and when that happens, they can easily drive down human capital costs, which will lead to margin explosion for Amazon as well. So besides their ability to increase their margins by simply focusing more on profitability, they also have this option of using robots to basically drive up margins even more. And so this is my thesis for Amazon. It is simply just one of margin expansion. The company has shown that it can do it, and I expect it to do it even more over the next few years as they continue shifting from growth to profitability. So for Amazon, besides that, the big beautiful bill will also lead to even more consumption. So Donald Trump actually came out with this bill, and he's doing a lot of different tax cuts. And what happens when tax cuts happen? It leads to even more consumption, which leads to even more growth for companies like Amazon and all your different other e-commerce brands as well. So there's one concern that a lot of Amazon investors fear today, which is the capex of the company. So the company is projected to have around $100 billion of capex this year, and the free cash flow for the company is basically zero at this point. So for Amazon, I'm not too worried about this one because their ROIC has shown some sort of recovery over the past few years. So in 2018, that was the previous highest point in terms of their ROIC, and currently we're seeing an all-time high figure for their ROIC as well. And if a company is able to maintain high levels of ROIC, then the capex isn't going to waste. The capex is actually growing the business. So this is my Amazon's fair value. So if you were to place a 15% EPS growth for the company, and assuming a 28 times multiple, then Amazon at $230 a share is likely overvalued. It's around an 8.5% CAGR. But if you give a more bullish estimate with the company growing at around 20%, then at 28 times earnings, the company is still trading at a decent valuation, giving you around a 13% CAGR over the next 5 years. So for Amazon, I think it is around overvalued today. It is slightly overvalued. I have my fair value of Amazon at around $200 to $210 a share. So I haven't been adding into Amazon lately. The last add was back in April. I'll be holding on to this company going into earnings. And this company is one of the companies that I'll still be bullish on going into the next few years. So the next portion that I'll be covering is the markets right now. So the markets are extremely bullish right now, and you're seeing price targets being increased as well. So Morgan Stanley's Mike Wilson, who basically said that the markets were going to tank another 20% when it was at 4,800 points, is now saying that the markets will reach all-time highs of 7,200 points by mid-2026. Oppenheimer also raised their S&P 500 year-end target from 5950 to 7100. So the analysts are always like this. They will always adjust their price targets according to the price action of the entire market. So when your markets are down, they will decrease the price targets, and then when the markets go up, they will increase their price targets as well. So I wouldn't rely too much on this one. As for the markets right now, the markets are going strong because you had strong economic data. So the PMI, ISM numbers came in strong, and inflation is still strong as well. Inflation came in at around 2.7%, which is slightly above estimate, but it is still manageable. It is still considered mild inflation, which is overall bullish for stocks. And you have the big beautiful bill as well, which is driving up consumption in the US, which will lead to more growth for all these different US companies. And that's why the market has seen around a 30% increase since the April dip that we had at around 4,800 points. So here are some opportunities that I see in the market today. The first company is ASML. It's on the left. So ASML this year is down around 8%. It is currently trading at a 24 times earnings. And for ASML, I think it is one of the better opportunities in the market today, especially with the monopoly that the company has. the company probably deserves to trade at between a 28 to 30 times earnings, and currently at 24 times earnings, I view this company as undervalued. The next company is MSCI as well. So MSCI year to date is down around 7%, and last week it was down around 15% or so year to date. So the stock now is trading at a 36 times earnings, and for a quality predictable business like MSCI, I think at today's price, it is still providing decent opportunity, and I'll probably keep an eye on this one if their stock prices keep falling further. The last portion that I'll be covering are some questions left in the comments. So the first one is with regards to LVMH. It says, while I understand that the situation in China largely impacts their revenue, they still have to come back from a significant degrowth. Even if they can come back to net positive growth with stronger consumer sentiments in China and resolve tariffs with the US, the luxury market is only projected to grow by around 3% until 2030. Of course, their current valuation is pricing in a lot of things and is historically on the cheaper side. The overall outlook is not promising as well. So I definitely agree with this one. This one is with regards to LVMH. So LVMH is a company that won't give you massive market beating returns. And with your luxury market only growing at around 3%, I think LVMH will probably grow at between 5 and 6%. It is basically a Berkshire Hathaway in luxury. So if you're buying into LVMH, don't expect the stock to give you massive market beating returns. But when you're buying LVMH, you're basically buying into a company that has strong capital allocation, that has a Berkshire-like structure, that has an amazing CEO as well. It is a quality business, but if you want to outperform with this stock, you will likely need to catch it at a very decent price and hope that it re-rates in the future, especially with the growth. The next portion that I'll be covering is IBKR. So it says, can you do a video on IBKR and its intrinsic value after the stock split? Thank you. So for IBKR, I think it is one of the better brokerages out there. The interface is amazing. I use the app as well. And for IBKR, I think it is the app that is less prone to retail investors coming in and gambling on the app itself. But for IBKR, it is definitely a company that is interesting, although I think it is overvalued today, currently at around a 30 to 35 times earnings. If we see a bear market when the stock market drops around 20%, all these different brokerages will not only see depressed earnings, they will also see their multiples coming down, and that would be the best time for you to buy into all these different brokerages. I hope you guys have found this one useful and invest safe.